Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's 18th of April, 2023, and we're past tax day. So a big sigh of relief. Unless you're like me, a lot of times we do extensions and you got 6 more months to stress out. Coming up on today's show, we're going to give you some nice, easy, conservative stocks, and they all pay nice dividends. They kind of calm you down, get you ready for post-tax season. All that and more coming up right now on Making Money. Most investors never touch this segment of the market, but according to the latest analysis from our team at Stansberry Research, this is the number one most important sector to pay attention to in 2023. And we're urging you to move your money immediately. You can stay one step ahead of the market and potentially unlock extraordinary gains just by understanding why this sector is set to boom. I strongly encourage you to read our analysis totally free today. It's all spelled out in a free report we just put together. Get the facts yourself. Go to hiddensector2023.com to get your free copy of this report. You can learn how to profit from the untapped potential in this hidden sector before it becomes widely known. Again, that's hiddensector2023.com for a free copy of our new report. Again, this is Matt McCall. Thanks for joining me. It is April 18th, 2023, post-tax day here in the United States. And this show is a little bit different. I want to dive into stocks that pay some income. I don't talk as much about that because a lot of my investing style is based around innovation, not technology necessarily, but innovation. And that innovation can be in a lot of different ways. It could be in technology companies, as a lot of people think about. It could be in automobile companies, companies like Tesla or Rivian, that are changing the landscape of the way people drive. We can go as far as even commodities. You look at commodities such as graphite and magnesium, or manganese, uranium, all in areas that are needed for whether it be the next iteration of electric vehicles, the next iteration of batteries, and uranium for what I believe is going to be a kind of a renaissance for nuclear energy. So there's a lot of different innovation that I look at, not just technology. So the stocks I'm going to talk about today are based off of income and dividends and solid, consistent dividends that have been paid over time, which is really important. Because a lot of times people come across and say, hey, Matt, I found this stock, pays a 17% dividend. Well, what did it pay last year? And, it's up and down, not consistent. That's very risky to me, especially if you're buying just for the dividend. Another thing to consider is, why is it 17%? Because a stock fell 80% and it's still paying the same dividend. More likely than not, that means a company's going to cut that dividend. And when you cut the dividend, obviously it gets the stock even more, because that's a sign that there's something going on underneath the hood, that the company's not financially sound. So that's a bigger issue. So when I look for dividend-paying, income-producing companies, I look for ones that have consistently paid out dividends. The payout ratio, which means of the money they're bringing in, they're not paying out all of it to a dividend. We obviously want to keep some in the coffers. So there's a couple of things I looked at. I came up with 4 stocks, and honestly, 4 very different stocks, from a burger chain to a travel company to a play on clean energy and dirty energy, to a play on basically, let's say, Amazon, play on Amazon. So without further ado, let's just jump into it and take a look at company number 1. And company number 1 is Prologis. The symbol is PLD. It's a large company that you may not have heard of, but it's a $112 billion company. They currently have a dividend yield about 2.85%, which isn't huge, but it's a nice little bit of income you get throughout the year. And if I take a look at the quarterly dividend going back to the last 10 years, it's consistently been raised every year, which is really important to see. And consistently just goes from lower left to upper right when it shows the amount of dividend that the company has been paying out. It currently pays out right now 87 cents per quarter. So obviously you take that by 4, and that gets us $3.48. Correct my math, I did in my head. But $3.48 per share, which works out to about 2.85%. So let me show you the stock here real quick, and then we'll talk about it. PLD again is a symbol of Prologis. You can see here in the chart, it's got a bit of a choppy kind of action in the last 18 months or so. I'm going to zoom out a little bit to give you a better picture of really what's going on with this company. And as you can see, it's had a really nice uptrend for quite some time. We then hit a high in 2022, along with a lot of other companies and sectors at the same time, just above 170. We pulled down just below 100. Now we're trading at like 122 right now. So it's, overall, the chart still looks solid to me. We just kind of pulled back with the rest of the market, but it bottomed in October, just like the overall market did. And since that time, it's been moving higher. So as I mentioned, on $112 billion company, 2.85% dividend. It's a real estate investment trust, which we call a REIT, REIT, real estate investment trust. This one specializes in logistics. Typically, you think of REITs, you think of whether it be owning shopping malls or owning industrial buildings, owning apartment buildings, large skyscrapers in cities. It could be anything. It could be storage facilities. It could be healthcare facilities. This one is logistics. And by logistics, what I mean is they own and operate those large, what they call distribution centers, DCs, distribution centers. And that's where, a lot of these logistic firms, such as think of like a DHL or UPS or FedEx or even Amazon, shipping everything out. They use these distribution centers that are strategically placed throughout the country to get the goods out quickly. That's how you get your Amazon order the next day because of this network of distribution centers that they have or that they use. And what I like about this going on right now with PLD is it fits into one of our trends. More and more packages are being delivered. I just got 2 updates literally before I started this show that I have packages waiting for me in Florida. I don't remember what I ordered, something from Amazon. But we're constantly ordering things on Amazon and other areas. I'm not saying retail is dead as far as going to brick and mortar, but it's just more convenient a lot of times. Now, if I run out of shampoo and I don't feel like walking to the pharmacy, I put it on Amazon. It's in my mailbox the next morning. So I know I live that way, and a lot of others live that same way. So this trend isn't going anywhere. So the need for distribution centers, which Prologis owns, is only going to increase. Another thing I like about it is the average lease they have is about 7 years. That's a pretty long time. So they're locked in for 7 years. If you take a look at their leases, the average lease is 7 years, which is nice. There's also a chart here I want to show you. And this is a chart of, if you take a look at what's happened with pricing per square foot, and as you're about to see, pretty amazing the pricing that we'll see here. Take a look at this, folks. Here's the pricing. You can see this is a net effective market rate for U.S. and Canada, where Prologis is based, and you can see just how quickly per square foot it's gone up. I mean, just back in 2014, the real rate, 2015 even, was around $4. Now we're up to $7. That's a 75% increase in that time frame. You can see the spike here in the nominal rates just from 2020 to 2022. As a matter of fact, last year rates alone per square foot were up 34%. So this company has a lot going for it right now. Again, big picture, more things are being delivered. It's got nice lease length. It's huge demand for distribution centers everywhere, and the rates are going up. So that all should equal, really nice bottom line. And as you can see here, paying a 2.85% dividend on top of that. The second one is a bit smaller. It's a $9 billion company. And this company is the symbol VST, and the name of it's Vistra, Vistra. This is a utility company. And if we take a look at the chart here in a second, you'll see it's a really nice looking chart. It pays a 3.3% dividend yield. It's one of the largest power producers and retail energy providers in the U.S. They own and operate 38 gigawatts of nuclear, coal, natural gas, and solar power generation. The retail electricity segment serves about 4.3 million people in 20 states. And the retail business serves almost 1/3 of all Texas electricity customers. You know how big Texas is, how many people that is. That's a lot of people. The company who came out of a bankruptcy of another company in 2016, the name of that company was Energy Future Holdings. It then acquired Dynergy in 2018, bigger. And they have plans right now. They're going to actually be acquiring yet another company by the name of Energy Harbor here in 2023. So I'll show you a chart. As you can see, it's really held up well. It's a big move in early March, and it's been consolidating since then. But again, look at the big picture of this. Um, as you can see, it's up against a big resistance level at 27. But, outside of the COVID pullback right here, it trades in a pretty narrow range over the years. So you're not going to have as much volatility typically in a stock like this versus if you went, more at a stock, like an innovation tech stock. So the volatility is definitely not going to be as high. The beta for Vista is actually 0.96. So same thing. It's about the same. So I was right anyway. As I mentioned, dividend yield 3.3%. And over the last couple of years, since the company went public, consistently raising the dividend since 2019, which is what we love to see every year getting raised. So it's got a lot of good things going for it. It's got that clean energy angle. It's got the dirty energy angle. We talk about the energy barbell a lot. This stock's got a little bit of both of that. So big reason why we like this company. The third one, we're going to shift gears completely. And I'm going to give you one hint, and you're probably going to know what it is. The hint is Square hamburger patties. Wendy's, of course. I just had a debate in Nicaragua. We were talking burgers, and I said dollar for dollar. I love the term pound for pound, but this is dollar for dollar. The best hamburger in the world, in my opinion, is a Burger King Whopper. And I had people laugh at me. And somebody said Wendy's was better. That's just insanity. Somebody said McDonald's. That's disgusting. Can't remember. There's a couple other ones that are thrown out there, but to me, dollar for dollar, the Whopper, probably more expensive now. I haven't had a Whopper in a very, very long time. But it was funny. I was in Managua waiting for my flight out of Nicaragua on Monday, and I had looked out of my window in my hotel, and there was a Burger King right there. But I resisted. I did resist because I was having a very healthy vacation. I didn't want to ruin it with a Burger King burger on the way back. So anyway, Wendy's. Let's take a look at the company, and we all know Wendy's, right? Square burgers. Picture of Wendy with the red little pigtails, whatever they're called. $4.5 billion company, pays a 4.6% dividend. So it's got a nice dividend. It's the second largest burger quick service restaurant and chain in the United States by system-wide sales. We all know who number one is, McDonald's. Sales in 2022 of $48.1 billion. Wendy's came in at $11.7 billion, and Burger King was number three at $10.3 billion. I can't believe it gets more than Burger King. It blows my mind. Nearly 7,100 units, stores in 30 countries. About 94% are franchised out. So they get money from that, obviously, and then money from selling, their products. Take a look at the chart here. Here's a chart of Wendy's, and as you can see, it's choppy, but it's holding up. It's not far from its recent high. And if we take a look at a long-term trend, it's moving up. And again, you kind of take away that 2020 COVID pullback there. The pullback in 2022 with everything else, but it seems to be firming up quite a bit. And it's at 2165 or so right now. If it breaks above 25, I could really see this stock running. And again, with a 4.6% dividend, I like that. I mean, that's a decent dividend if you think about it. It's not going to be something that's double digits, but you're looking at a company that's pretty consistent. It's number two in the country, as I mentioned, with sales for quick service restaurants. So it's held up well. When I look at the dividend history, the only thing that pops out is consistently raises dividend over the last decade. But there was a time in 2020 during COVID that its dividend was at 12 cents per quarter, 12 cents a share per quarter. And they cut it down to 5 cents in May and August of 2020, and then immediately came back up. Now we're up at 25 cents per quarter, so $1 a year. So suddenly you're back at double what it was pre-COVID. So that's a really great sign how quickly they bounce back from the COVID situation. And then the fourth one we're going to take a look at is travel and leisure, which is symbol TNL. It's a $3 billion company, pays a 4.8% dividend, which is even nicer. That's a really nice dividend. And if you've never heard of Travel and Leisure, it's basically a membership and leisure travel company. They have hospitality services. They have segments of vacation ownership, vacation ownership interest, which to me sounds more like timeshare, but that sounds a little bit nicer. They also have property management services at the resorts, and it's one of those types of membership things that people get into and they love it. And so it's something that I don't think is going anywhere. People love the travel. People love experiences. As I mentioned, $3 billion company. If I look at the dividend history, which again is extremely important, their dividend actually took a dip back in 2018, and then again at COVID, down to 30 cents a quarter. Now we're back up to 45. So it's added 50% since that time. Again, I like to see them coming back because COVID was a weird time that a lot of companies were forced. And you think about travel and leisure, you weren't allowed to travel. So, Wendys, people weren't going out and eating as much. A lot of places were shut down. Workers couldn't get in. So these were companies that were directly affected by the government imposed shutdown. And so that's why you see them pulling back their dividend at that time, which was prudent. You usually don't want to see that, but there's good reasons for why it happened. And since that time, they've come back very strong with increasing the dividend. So let me show you a chart here of travel and leisure. Not the greatest looking chart, but we bottomed in October, tested November, tested December, kind of going sideways, building a base. If I zoom out a little bit longer, very choppy chart, but it seems as, taking away COVID again, when we pull back to this 34 level, which it just hit last year, we're at 38 now, seems to be a nice buying opportunity. So again, nothing here is a buy or sell recommendation, but I wanted to share 4 stocks that still fit trends. Travel and leisure, I believe travel is going to come back strong. I believe the millennials will continue to travel the experience route that they have taken. Wendys doesn't really fit into really anything big other than the fact that I wish I could say that we're getting more healthy, but we're not. We're getting more lazy, I believe, and that's unfortunate. But that's a trend I don't want to believe in, and that's why the trend of diabetes is booming, because people eat too much high salt, high sodium, high fat, crappy food. I'm not saying Wendy's is crappy food. I'm just saying it's not the healthiest for you. And then we have obviously Vistra, which is our energy barbell, both dirty and clean, and back to Prologis, which is all about distribution centers and more people ordering things to be delivered, instant gratification. Hey man, we want instant gratification. We want our heat through Vistra. We want our burgers, and we want to travel. So that makes more sense like that. But again, I want to cover some income producing stocks for you, something to throw on your watch list. I think it's a buy or sell recommendation here. But again, educate you, have some fun, and eventually, as we always say, let's make some money. Thank you so much for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.